Hey folks, Dan Frio here, the Mortgage Update. Today I want to dive down this tunnel of housing bubble. Is there a housing bubble? When will it explode, if it's going to explode? What actually causes a bubble? And that's what we're going to discuss here. So don't go away. We're going to do it right now. Okay, so the reason for the video is I see a lot of YouTubes and a lot of information out there in regards to a housing bubble. So what causes it? What caused the last one? When should it take effect? Let's dive down all these areas. So let's get to it. The biggest thing that created the housing bubble in the past was, and you're going to see a common theme for this, it's basically hedge funds, subprime products, I'll put it that way, interest-only products, no income, no asset products. There is a myth saying, well, the Fannie Mae and Freddie Mac wanted everybody to own a home. Well, any developed country or developed entity, home ownership is wealth creation. So that's why a lot of people wanted, strive for home ownership. CDOs, which is collateralized debt obligations, is another creation on Wall Street to help out the subprime business. And then subprime mess, basically crashed the whole banking industry. So if you see a common denominator here, basically it's all tied around subprime stuff. And Wall Street created all kind of mechanisms to create subprime loans to basically make home ownership too easy. And I'll say this, not everybody needs to own a home or should own a home. I'll go out on a limb, not everybody should have children. It is what it is. So the biggest reason or the biggest cause of the crash back in 7, 8, 9, and 10 was exactly this. So people were getting loans. I've been in this for going on 33 years. I saw the good, the bad, the ugly, the absolutely terrible. So what happened is, it's kind of like, and I'll say it right now, student loan debt. Kids can go to college, any college they want to basically, and afford it because government loans are just easy to get. You really can't be turned down to a point. And the bad thing is you can't ever bankrupt them or anything. So it's creating this huge bubble where, why do you think colleges can just keep increasing their prices? Because students, it's easy to get a loan to go to college. So the easier you make money, the easier you're going to create a bubble. And I see the bubble more in student loan debt than anything right now. Okay. So that being said, here's what's happening with the housing. Let's go back to the housing market or the mortgage market that it caused or created the bubble back when. Let's kind of dive back in to see what the rules were back then to qualify to buy a house. Well, a 580 credit score was really good. It was a great credit score to get approved. You could actually get approved for a no income, no asset loan up to 100% financing. You could do what's called an 80-20. We would do an 80% primary loan, 80% of the home's value, and then we would couple it with like a home equity or second mortgage at 20%, and all that could be wrapped around. You had a 580 credit score, and because you had such a great credit score, we know you pay your bills, so we don't even really need to validate your income. A recipe for disaster, a recipe for fraud, misrepresentation, the whole ball of wax. So you would see people making, waitresses or waiters, nothing against that field, but you would see those kind of fields getting into mortgages for $300,000-$400,000, and they would put on the application, well, I make $10,000 a month in tips and stuff like that. Again, they had a 580 credit score, great credit score. They're paying their bills, so why shouldn't we believe them? They signed on the dotted line and said they make that amount of money. Well, everybody started to do that. So what you're doing is you have a stagnant demand of homes, but you have, supply, but you have a huge demand because everybody now wants to buy a house. That's driving up the prices of the home. So what was happening is somebody would qualify for a home, they'd buy it. 6 months later, that home is worth 50% more because there's so much demand. Everybody and their mother's trying to buy homes and qualifying. That's the biggest thing, qualifying, is it kept this creating a higher and higher and higher value of homes. People started using homes basically as an ATM machine. They would get it, refinance it, get a bigger loan on it. 6 months later, the house value would be more because more and more people were buying. They'd get another mortgage there and keep riding this up. There were subprime loans that had teaser rates. Most of the time, or a lot of times, they were interest only for the first, say, year, 2 or 3. And they were on people that really didn't validate their income. So as the house values keep going up, people would keep refinancing, pay off other bills that they had because they couldn't really afford what they had. So then all of a sudden, things started to stagnate and you didn't have values skyrocketing, 30, 40, 50% every 6 months or so. Now all of a sudden, people couldn't afford to refinance their house, go back into an interest-only loan for another year or two, which made the payment virtually nothing almost, or a fraction of what it would be. And then they were running up credit cards too because they overbit what they should be able to afford. That created this big mess. Okay, so then what happens is the person couldn't refinance anymore because they were already maxed out on the home value. Then their mortgage resets. Now their mortgage payment doubles because now they have to pay principal on top of it. Oh boy. Well, I ran up other bills too because I kind of over exaggerated on how much I make. So now my mortgage payment just doubled. I can't refinance and use my house as an ATM anymore. I have all this other debt I accumulated because I was over living. I say everybody was at fault at this. Wall Street, bankers, home buyers, the whole slew of everybody. You're making 50 grand. You truly, the way the numbers work, you kind of can't afford a $500,000 home. The math just doesn't add up. So what happens with this is we hit that point where all of a sudden now nobody can start cashing out on their home. They can't refinance anymore. They're stuck. And they're stuck in a position where it's like, I can't afford these payments. Everybody should have known I couldn't afford these payments. Well, when you sign the application, you might have been coerced to get, sign those papers because you love that house. But now that ride stops. So then what starts to happen? Well, people start to go into default. They can't make those mortgage payments. They can't refinance. Now what? Now they just start buying time. Well, I'm going to stay in this house as long as I can. I'm not going to make any mortgage payments. Thus, what happens? What is the main piece or what causes home values to drop? Well, great question. So let's go over to and Google it for a second. What can cause home values to drop? Well, believe it or not, the value of the home having short sales and foreclosures will cause your house value to drop. Okay, well, that's where we are at that point. Now people aren't paying. They're like, I need to sell this place to get out of it. Well, now I owe more than I do. I mean, the house is valued less than I owe. I got to sell this anyways. So what am I going to do? Well, let's try to short sale it. What a short sale means is you short the payoff. You owe more on the house than it's worth. So you're asking the bank, can I short the payoff, meaning give you less than what I owe you? The bank's at first like, no way. We lent you the money. We lent you $200,000. We want our $200,000 back. Well, the house is only worth $150,000. We don't care. That's your problem. It's like if you buy a stock, you can't go back a year from now saying, it dropped in value. I don't want this anymore. Give me my initial investment back. It doesn't work that way. So what happened is then people start getting attorneys and start filing litigation, all this other stuff, and trying to do modifications, everything and anything they could to delay the inevitable. So then what would happen is they started learning the system. They would stay in their house for 1, 2, 3 years without making payments. Eventually, this is going to come to an end. And then all of a sudden, that's when you hit poof. And the world basically started to crash. So what started this? Well, all the derivatives, everything that the banking system and Wall Street created, which gave the people the ability to do, I call them liar loans, get into a loan of you don't have to verify your income. You don't have to verify your assets. You have a 580 credit score. That's good enough. Let's finance you 100% of the house's value and get you into the property. That's what created that bubble. Okay, the euphoria of home ownership and so forth just over-exaggerated this whole thing, but the one culprit was all of the stuff that Wall Street created and the banking system created. Those are gone, and they've been gone for a long time. So now to qualify for a mortgage, you need a good credit score. 580, you can't virtually even get a mortgage anymore. In some cases, you might be able to get an FHA or VA loan. But you're really starting at 620, 640-ish if you're looking to buy a house. You can't finance 100% unless it's a USDA or a VA loan. You need some skin in the game. There are no stated income, stated assets. You have to validate your income. Whatever you file taxes on and the income you show on your taxes, that's what's used to qualify. There is no subprime loans anymore. You have to have a good credit score. You have to have a job and validated. You have to have income and validated. And you have to have assets. You have to have skin in the game to buy the house. That's that part of it. So the bubble piece. So the next thing is you might want to say, well, house values are still increasing higher than the inflation index should cause them to increase. Yes. Because people can get into home ownership a little bit easier now because of rates. But it's still, there are no liar loans. You still have to qualify for that mortgage. Your mortgage payment isn't going to go up. There isn't the interest-only programs. They don't exist anymore. So your house payment, the only way it's going to basically increase is if your real estate taxes go up or your homeowner's insurance goes up. There are adjustable rate mortgages. Those are usually 3 to 5 to 7 year adjustments, and I've probably done 2 in the last 5 years. So you take out all of that uncertainty. So now the next step is people are going to say, well, how about the world just basically took a hit because of the pandemic, the coronavirus? Great point. Here's what's happening in there. I always suggest, please, unless you have to, don't do the forbearance program, because basically that's just kicking the can down the street. What a forbearance does is this. It's giving you the opportunity to postpone, I'll put it that way, 3, 6, maybe even 12 months more worth of mortgage payments. But they're still owed somehow, some way. And there's a whole slew of ways that money is owed back. So even if you go through this pandemic, you have an option or the ability to basically postpone your payments. It's not like back when basically the banks are saying, no, we lent you the money, you owe us that money back. Everybody learned their lessons back then. They're saying, okay, you can postpone and let's put this at the end, or let's postpone it down the road a little bit, or whatever. The banks learned their lesson back in that time frame. So that's one area where I think we have a cushion there. Another area that a lot of people, there are a lot of people suffering. However, just so you guys know these numbers is when the pandemic hit, there was $800 billion in income that was lost, meaning those $800 billion in salaries basically stopped because people were furloughed or let go or whatever. However, there was $2.1 trillion in stimulus money pumped out. That's 3 times the amount the government pushed into the system via payroll, PPP, and other things, unemployment, that got pushed into the system. So a lot of people, believe it or not, and hopefully I'm not offending anybody, people are making more money sitting at home than they did working. So, and that's proven in many cases, because $800 billion in wages were lost, but the government pumped in $2.1 trillion in PPP and unemployment benefits and everything else. So there's more income in there, thus allowing more and more people to still be able to pay their bills. So I don't think we're going to have a huge default at any time soon because of the pandemic, because the forbearance is helping a lot of people. And a lot of people went into the forbearance program that really probably didn't need to. But they're like, if I can skip 6 months mortgage payments, I'll skip 6 months mortgage payments. I don't blame you, but you're going to have to pay it at some point. So that's really, the forbearance is helping a lot of people. The stimulus plan by the government is helping people that they're not completely just losing their wages. Will we have a comeback or a little bit of a drawback in home values? Probably. And that's, everything's cycled. The stock market cycles. I don't predict a crash. A pullback, yeah. A crash, no. So that's basically my talk about the housing bubble, and will prices come back in some areas? Yeah. In other areas, maybe not. But look at it this way: if you buy a house and you're not looking to plan on selling it in the next 2, 3, 4 years, doesn't matter. And I don't mean that in a rude way, but think of longevity. You usually get into a house. I've been in my house for 19 years now. So it went down through the cycles of up and down, but I still have a house. I'm still paying on that mortgage, driving down my mortgage balance. Eventually I'll owe nothing on that house, and that house will have value. So unless you plan on, buying and flipping and now the flippers might have some problems. But if you're buying and putting in a hold pattern on it for 3, 5, 7, 10 years, I think you'll be fine. So if you like my videos, all I ask you to do is please don't forget to give me a thumbs up. If you would subscribe down below, hit the bell so every time I do post a video, you get an alert. I try to title them really good, so if you read the title, you kind of know what the video is about. If you want to watch it, great. If you don't, skip through it and wait till I post another one. My name is Dan Frio. I do the rate update every day on YouTube. I podcast it and do a whole bunch of other things. If you'd like to reach out to me personally, here's the best way to get me. Go to therateupdate.com. So therateupdate.com. Right down here is my number. You can reach me. Call me. You can speak with me personally at 844-775-LOAN. That's 844-775-5626. Or you can reach me via email. Again, my name is Dan Frio. So my email address is D for Dan, Frio, which is Frio, at preferredrate.com. If you'd like to apply for a mortgage and get pre-approved to buy a home, all you got to do is click here. If you want to see what we can do for you in regards to a refinance, click here. Fill out as much as you can. We'll get back with you within the hour. If it's during office hours, if it's in the evenings or weekends, please be a little patient. We'll get to you first thing Monday morning or the following morning. And at least most likely we call you, kind of pick your brain, let you ask any questions you have so we can answer those questions for you so you can get it right from an expert. So thank you so much. God bless. And I'll hope to hear from you soon. Bye-bye.